That's everyone. Can you hear me? Hello?
Yes, we can hear you.
Oh, yeah. Okay, good. Thank you. Yeah, hope everyone is doing well. Uh, so we're quite complete right now. Okay. Yeah, nice to see you again this week. So we have exciting topics today, um, which actually continue our discussion last week, but this time, uh, yeah, we try to apply what we have seen last week into the foreign exchange market. So we have two chapters or two topics today. The first one is more qualitative. It's about the linkages between or among uh, the exchange rate and um, like government policy and also balance of payments. I think this is quite uh, a famous topic, I think, during the pandemic because many countries have to run government budget deficits, right, to give money to people, to the unemployed, and yeah, this will somehow change the configuration of the countries. Usually, some countries are traditionally having current account surpluses. Some have traditionally current account deficits, like the United States or some other industrialized countries. But as usual, today I will start with the quantitative one. That is the foreign exchange market or the subsequent chapter. So we'll see the foreign exchange market first today, and then we'll go back to the linkages between balance of payments and international trade, and also government policies. And finally, we'll see your presentation because that your presentation is more related to the qualitative part, right? Which is the Federal Reserve or central bank system. Right? We're comparing the two people there, Yellen and Bernanke, right? And both of them are not in their positions anymore because now the Federal Reserve governor is Jerome Powell, right? Jerome Powell right now. But we can see the experiences of those people, and you know that in the United States, their Federal Reserve or central bank is highly independent, right? Not because not because they're better or they're smarter, but because of the media. You can imagine what will happen if the president of the United States tries to force the Federal Reserve governor to print more money or to lower the interest rate or to increase the interest rate and so forth. Then, yeah, definitely the news will leak out to the media and the president will be in a big trouble. So, you know that they're more independent because of many factors. So, although the Federal Reserve governor is proposed, uh, is proposed by the president to the Senate, but again, the confirmation is quite severe. I think if you follow, the development of the U.S. Public figures or public position holders, the confirmation process is quite severe. Like Federal Reserve governor, even a secretary or a minister, and then the federal court justice or justices. Like the confirmation is quite tedious, and it will be shown to the media. I think that's the only country that shows everything to the whole world. So we know how they elect people, how they confirm certain people to certain positions, and we know that they quarrel, they don't agree on many things. So we know everything because they show everything on the media, and it's quite strange, but it works out for them. So again, the central bank is quite independent because of many factors, because of their tradition, because of the regulations, but also because of the media. So you cannot force anyone to do anything. Although, again, the central bank governor is proposed by the president to the Senate, but again, it has to be confirmed. And once confirmed, I think the governor is not really, not really allegiant to the president. He or she doesn't always follow what the president wants. Right? So that's the beautiful thing that we'll see today. So you see, like Janet Yellen was elected during the Obama presidency. Right? Janet Yellen. Ben Bernanke was between George Bush and Obama. See, this is also the beauty of the system in the United States. Usually the central bank governor, the Federal Reserve governor, has the election year in the middle. So for example, Trump was elected in 2016, but the change in the Federal Reserve governor happened in 2018. So you see the incoming president has 2 years to work together with the previous or the incumbent Federal Reserve governor. You understand what I'm saying, right? So they have like a 4-year incumbency, but it's in the middle between the president. So for example, Trump will finish in 2020, and we don't know whether he will be re-elected or not in November, right? But Jerome Powell will have his incumbency until 2022. So whoever the president will be, right, in November, will have to work with Jerome Powell for 2 years at least. So you see, you could develop your chemistry, your friendship, your cooperation or something like that with the incumbent Federal Reserve governor. Okay. But before we see your presentation, we're going to discuss the foreign exchange market. Okay, so as usual, yeah, I can see your name here. As usual, if you have questions or comments or anything, just unmute yourself and raise your questions, okay? Okay, so foreign exchange market. This is quite strange that we call it a market, right? The foreign exchange, we talked about this for the last 2 weeks. We know that foreign exchange or currency is actually a means of payment. Right? Huni, if you want to buy something from the United States and from America, then you have to pay with dollars. Right? If you want to buy something from Singapore, then you have to pay with Singaporean dollars. So essentially, this is a means of payment. But yeah, we didn't have a chance to talk in details about the international monetary system last week, but you can read from the lecture notes or even better from the textbook that the foreign exchange system or monetary system has evolved from time to time, from the gold system and then the semi-gold system, and finally the pure market mechanism or floating system. And of course, some countries are still using the managed floating system. So although their currencies are floating, but every now and then they will come to the market to intervene, right, to manage the floating system. But essentially, now we are having the fiat money system or the floating system. So somehow the foreign exchange has been a market as well. That's quite interesting, right? Foreign exchange, if you think about it, suddenly, a means of payment has turned into a market as well. Market means there are many people who want to buy something, whereas some other people or the rest want to sell something, right? So this is quite interesting. So we call it foreign exchange market because somehow this has become a big market of itself. And if you follow later, we see that the trading volume of the foreign exchange market is enormous. If you see the statistics right now, it's even more than 5 trillion, more than $5 trillion a day. Can you imagine? This is a big market, $5 trillion a day. The transaction volume or the size of the daily size of the market. So imagine $5 trillion in this, that's a lot of money, right, per day, right? A day. So even a small, if you are a small trader or small currency broker or dealer, that's really a big cake, right? A big chunk of cake for everyone. So several years ago, I had a client. My client was headquartered in Singapore. So this is a consulting firm, but specializing in this kind of thing, like foreign exchange market, and not entirely offering the consulting service or the execution service, but also the training. So it had a vast array of business lines, right, from training and then business, the artificial intelligence. So they employed a big data analytics, artificial intelligence to help the clients. So how they develop, they train students to make decisions and so forth. So it's quite a comprehensive consulting firm specializing in foreign exchanges. So one time I asked the owner, so with this kind of artificial intelligence or business analytics, big data analytics, can you somehow, in the future compete with like Thomson Reuters or Bloomberg or some companies like that? And the owner replied to me, never, never. So we'll never compete. We'll never be able to compete with Bloomberg or Thomson Reuters or some top business analytics company. However, he was saying this: the pie was big. You understand what I'm saying, right? The cake is big, right? So if the cake is big, even a small company like his or some other companies will still have like enough money to enjoy, enough money to reap, because the pie is really big. You can imagine that $5 trillion a day, and maybe some of you are now working at such an industry, like the foreign exchange industry. You can imagine the money is really big. Of course, the work is hard. You can imagine like we have like different time zones in the world. Right now, we are in the morning right now. We are AM, but the United States are sleeping right now. Almost. They are at night. Of course, the Pacific time will be a bit later, but essentially they are at night right now. You can imagine later when we close our market. We close our market at 3 or 4, and the Europe will start. Like the European market will start, and when the European market closes, the American market will open. So it's essentially a 24-hour job. So usually the undergraduate, when someone graduates from an undergraduate program, it's quite tempting, quite compelling to go to this industry, because you will make a lot of money, but with a lot of sacrifice, a lot of time, and also maybe a relationship and something like that. I mean, if you watch the movie Wall Street, Wall Street the Second, especially at Wall Street the Second in 2010, Money Never Sleeps. You see the young guy was working like crazy, right? Now you can imagine, because it's essentially a 24-hour market. However, the money is good, right? Money is really good. You can imagine the size of the market. And if you compare the size of the foreign exchange market with the equity market, actually the equity market is well behind, like in terms of the amount. And if you follow that, even the biggest equity market in the world at the New York Stock Exchange, they have a daily trading volume of about 100 billion. $100 billion a day is big enough, right? But if you compare it to $5 trillion a day, it's nothing, right? Crazy, right? So again, this is a lucrative market for people who want, who are keen in getting quick money as soon as possible during maybe the first stage of their career. Right? Maybe you work from 22 years old until maybe 30 or 32. You earn a lot of money and then you quit. Right? when you quit, you start another job, maybe teaching job, or maybe whatever, opening a store at the mall or something with the money. So yeah, there are many alternative or choices with that. But see here, foreign exchange market, the transfer of purchasing power are denominated in one currency to another. So essentially, this is like an exchange market, right? So you exchange one currency to another, but it has become a market because of the expanding function for merely a means of payment to, another class of investment asset. Somehow you hear, people, like many brokers or dealers are offering to common people, right, about their investing in US dollar, right, investing in whatever, right, Canadian dollar or anything. So the biggest clients are major banks. That's why the major subset of the foreign exchange market is the interbank market. So these transactions are huge, right? The transaction among the banks, right? The bigger banks, in Korea, in America, everywhere. And now we are essentially boundaryless because of the information and communication technology, and also transportation is very easy right now. Even if you want to go to America right now, it will take you only maybe from Korea 15 hours, or 15 or 16 hours. It's very easy, right? It's just like taking trains, right, from one place to another, back and forth. So very, very easy. And we have seen this one, right? Spot market. Still remember spot and forward markets? Still remember that spot market means that what is it again? Can you tell me again? Spot market. Ryu, can you tell us again the spot market? Yeah, please.
Yes. Buy now and give the money
The
2 years later. Yeah, 2 days later. Yeah.
That's 2 or 3 days later. Yeah, that's
Yeah.
right. That's right. Thank you. So spot market, right? So you make the deal right now. You buy or sell right now. You make the deal, the agreement right now, and the delivery will happen right now. So the definition of right now is maximum 2 or 3 days from today, right? So it's still considered a spot market. On the other hand, the forward market, can you tell us, Yumi, maybe? Where's the forward market again? Forward
Yeah,
transaction?
both market the deal is now and the delivery is future.
Therefore, in the future, future could mean next week.
Yeah,
right?
just 1 year
Or,
later
4
or a
days
2 year
later.
later, like that. Yeah.
That's right. Yes, thank you, Yubi. So even 4 days later, 4 days later is considered a forward market, right? It's already more than 3 days, 2 or 3 days. Okay, so major participants again is the interbank market. So major commercial banks, foreign exchange brokers, right? Commercial customers, of course, multinational corporations, big corporations, and surely the central banks, because they have to go back and forth to intervene, right, to manage the floating system and something like that. So this is interesting one, right? We used to call it a broker. A broker is an intermediary to connect one person to another. I mean, if you work at the insurance industry, you know that many of us started as an agent, in the insurance agent. So that's essentially an intermediary, or very similar, has a similar function to broker. As you intermediate the transaction between the buyer and the seller. And see here, foreign exchange brokers. So in the past, and even until today, some brokers will specialize in certain currencies. Some other brokers will specialize in other currencies. But now, because of technology, we could specialize in many currencies simultaneously, because you have the technology, right? In the past, if you again, if you watch the documentary or even some movies about the financial markets, you can see that they still had to use hands, right? So buying and selling, right? And then they have the code like 1000, right? 100 and something like that. But now we have the automated trading systems. So it's much better, right? So everyone could contact their brokerage firms using computer everywhere, even in the middle of the sea or even in the toilet, right? So everywhere. So it's it has made the system leaner in terms of the intermediary system. So we need fewer human brokers, but we have more the technological brokers. But still, right, the function of brokers is there. So we see the big commercial banks involved in foreign exchange market. See Citigroup, JP Morgan, UBS, and so forth. So yeah, traditionally major banks in the world, so they dominate the foreign exchange transactions. I think it's quite understandable because it's the biggest markets for this one lie in like New York, London, Singapore, and some other big financial capitals in the world. So they buy and sell, like commercial and central bank customers. If we buy something from Amazon, from eBay, so we have, yeah, of course we pay using foreign currencies, but they will be translated by our local banks in Korea, in yeah, everywhere, in Vietnam, something. And we see major participants here. There's actually our main topics from today to till the end of our semester. The first type of person or entity is arbitrager. You can see the word here. The English word is arbitrators. So these are people who try to get arbitrage profit, right? The arbitrage profit. You still remember the meaning of this word, arbitrage? Huni, can you still recall the meaning of arbitrage profit?
Sorry, I don't know well. Sorry.
Okay, no problem. And anyone here? Arbitrage, what does it mean again? You try to get easy money?
I think no risk and but get capital gain.
That's right.
Yeah, no risk
So you try
and
to
capital
get
gain. Yeah.
Thank you, Jinsu. Thank you. Yeah, that's right.
Yeah.
So you try to get like easy money, right? So maybe you buy at one place and then you sell it at another place, exactly the same thing with different prices. So you get easy money. You even get profit after cutting the transportation cost or the transaction cost. Easy example, maybe you can buy, if you can buy MacBook, maybe, right? If you go to maybe a neighboring country like Taiwan, right? You go to Taiwan, if you can get a MacBook, exactly the same MacBook Pro, 16-inch at maybe 1,500, 1,500, but actually you could sell it in Korea for 2,000 plus, and even after cutting the transportation and transaction cost, you still get profit. So we call it arbitrage profit, right? So riskless or easy profit. You buy something at one place, and you try to sell it at another place with different prices. So you get easy profit. So arbitrage profit. So these are people who try to always explore the possibility. If I can exchange US dollar to Korean won maybe in Tokyo, compared to if I do it in Seoul, maybe there's a big discrepancy, even exceeding the transportation cost, the transaction cost. I still gain something if I do it in Tokyo first, and then I resell it in Seoul, and I will get arbitrage profit. So this kind of people always try to, again, exploit the possibility. But however, you can imagine that because of the technology, right? Because of the information and communication technology, the internet, 5G internet even, the possibility of doing this has been lower and lower. You can imagine in the past, when we heard of certain news, maybe certain news about vaccine, right? The COVID-19 vaccine or COVID-19 medicines, therapeutics medicines or something like that. So in the past, it would take maybe 1 hour or 2 hours before the news reached common people. So of course, the news first would come to traders, because we are traders. We have the networks, we have the strong relationship with other traders from all over the world. So we would know the information first. But the common people, the lay persons, they would know maybe 1 hour, 2 hours later. So some people had the opportunity to execute this news earlier. You understand what I'm saying, right? So if you heard that there was a problem with maybe Citibank, for example, right, internally they had like severe problem, maybe financial statements problem or something like that. Of course, we as traders, we got the information first, and we could act on it, right? We could harness the information to make quick decisions. Right? We bought or sold the currencies, and other people didn't know. Right? But nowadays, you can see you can imagine the situation. Everybody knows that. Even we, as common people right now, we would get information like within seconds. Whatever happening in the United States, whatever happening in Australia, we, for example, in Korea, will know the next second, right? So the possibility of getting this kind of arbitrage profits has been much lower because of technology. So many people, many traders now have robots, the robots that will execute something. If you tell the robots, especially if the robots have like big data analytics, right? You tell the robots, okay, based on the incoming data for many years, you analyze the pattern. So you can use the technical analysis, for example, the Fibonacci model, or you use the whatever, right? The candlestick pattern or anything, head and shoulder, whatever patterns you tell the robots, you tell the robots, if, for example, if the Korean won increases above 1,300 per dollar, at 1,300 per dollar, then buy, for example, right? We could just you just use your robot, right, to make the analysis and finally make a quick decision. Or yeah, you can tell a robot if Japanese yen goes below 99 yens per dollar, then you have to sell. You can make that kind of decision in robot. So if many traders are using robots, you can imagine that the execution of transactions will happen quickly. So again, the possibility of getting this arbitrage profit has been lesser, has been lower, and maybe one individual trader will only have like maybe 1 minute to execute on the some mistakes, mistakes in quotation, mistake in the forward quotation that we saw last week. If there's a misquote, then you have the possibility to gain an arbitrage profit. However, again, the possibility of getting this profit has been lower because of technology, right? The quickness, the speed at which all traders in the world execute their transactions. And the second one, any idea here, traders? These are normal traders, right? So you need the foreign exchanges, you need the foreign currencies for trading. So if you are LG, if you are Hyundai, if you are Samsung, definitely as companies, as multinational corporations, you are traders. You need to trade. You need to you need to ship your goods out to the whole world, to all over the world. But you also need to buy maybe materials. You need to buy certain materials from China, from Taiwan, from America, and so on. And the third one is hedgers. So this is an interesting word. The English word is to hedge something, and the noun is hedging. Anyone here knows the meaning of a hedge? Anyone here? In again on your name, please write the Roman version of your name, okay? So that I can pronounce your name. Yeah. Maybe as Lok Ha. Yeah, Lok Ha. Can you explain, or can you do you by chance do you know the meaning of hedge? A hedge?
Yeah, hello. I think that hedges is the behavior that prevents someone from doing something. I guess so. It's like a barrier. It's like a barrier.
Like a barrier. Yeah, thank you, Lok. Very good. So hedge is like a barrier, or you can simply call it a gate. Easier to imagine, right? So you have a gate, right? You have a barrier. So you try to hedge something, means that you try to gate something, or you try to protect something, right? To cover or to protect. So the original meaning is a gate, right? So you put a gate on something, meaning that you try to protect something, you try to cover the value of something. So the noun is hedging. So this is hedgers, the people, right? People who want to do the hedging, right? People who try to hedge or protect the values of their assets. So we'll talk a lot about hedging process next week, and also the week after, right? So next week and 1 week after the next. So hedgers, so they're doing the foreign exchange transactions to hedge, right, to protect the values of something. Maybe the values of their major transactions, the values of their assets or whatever. So they do the translation, right? They do the conversion of exchange rates to protect the values of their assets, essentially. And we'll see this a lot from next week onward. And last one here, speculators. Oh, this is interesting, right? Speculators mean, what is that? You speculate, right? You wake up in the morning and you try to make quick money, right? Because maybe you got a dream last night. We don't know. So you got a dream last night, and you think that the dollar value will increase against Korean won or against Vietnamese dong or something, right? So suddenly you wake up in the morning, you buy a lot of dollars for no other reasons but speculation. Right? So you try to speculate, because you think that your guess or your prediction will be correct. Right? It's like gambling, right? Essentially, not exactly the same as gambling, but similar, right? So for example, you go to Macau, or you go to MBS in Singapore, you go to the casino and you make a bet, right? So like banker or player, right? The baccarat game, banker or player, and there's no logic, right? No technical reason. You suddenly put your money, $1,000 on banker. You hope the red will turn out red, but there's no other reason. So you're speculating, right? Essentially, you're gambling. So you see the difference now between the hedger and a speculator. Speculator means you don't have any other reason. You just go to the market, you exchange the currencies or exchange rates by foreign exchanges simply for speculating. But hedger means you have something behind it. So for example, here, and then again, please write your Roman names, okay? Roman in Roman alphabet, so I could pronounce your name. I'll start with Tae Wong. Tae Wong, for example, you are a hedger. If you're a hedger, again, you have something behind you. You try to protect the value of something. Can you give an example why you, what are you trying to protect? Any situation? You try to protect a transaction or an asset, anything that you can imagine. Just give us a simple example. What are you trying to protect? What asset?
I have start of Apple.
Okay, so for example, maybe you are a trader, okay? You have an Apple store, and you have to buy a lot of Apple when they have new models. You can imagine usually maybe in November or December, they will launch like a new model, maybe MacBook Pro or something. Let's say in November you buy maybe 5,000 laptops, right? 5,000 Macs. So you don't know about the price, right? You don't know about the unit price of the Mac, and you have to pay in dollar. Imagine, right? You have to pay in dollar. So Taewon, what are you afraid of in November? Because now it's September, right? You still have maybe 3 more months to collect the money, right, to pay or to buy the Apple computers. What are you afraid of in December? Increasing value of dollar or decreasing? Which one?
Increasing dollar.
Say it again, please.
Increasing dollars.
That's right. Very good, right? So you see that in December, you're afraid of appreciating dollar or increasing value of dollar, right? Appreciating, right? Because again, in December, you have to pay maybe 5,000 times 2,000. That would be about what? 10 million, right? $10 million. So you have to pay $10 million in December, right? But you don't know, right? The value of US dollar to Korean won in December. That's a problem. So if the US dollar increases, then suddenly it becomes more expensive, right, to pay in Korean won. So this is something you're afraid of. That's why you go to, again, you do the transaction, right, in the forward market that we are going to see next week, right? Next week we'll see this in detail. So Taewon is an example of person who is considered a hedger because you have something, right? You have a transaction, so you need US dollars in December. You need a lot of US dollars in December. You need 10 million. So you are afraid that the US dollar will appreciate, right? Will increase in value. So suddenly they become more expensive. Actually, you still have to pay $10 million, right? No problem with that. Maybe you have an agreement with Apple. But the meaning of $10 million would be different if the US dollar appreciates. Okay, so that's a hedger. We'll discuss this in details from next week onward. What about speculator? Speculator, maybe Sungwook, okay? Sungwook, if you're a speculator, can you give an illustration? You just go to the foreign exchange market to speculate. Any illustration that you can show us?
I don't know.
Yeah, you have nothing right now. You have no transaction, nothing, right? You have no interest, actually, no business interest in US dollar or in, yeah, whatever, Japanese yen or anything, right? But, or euro, right? But suddenly in the morning, for example, on Monday, right? Maybe you had a good dream on Sunday night, and you wake up on Monday, and you just go to you just call your broker, call your dealer to buy, let's say, 10 million euros, because you think that the value of euro will increase, will appreciate. You understand what I'm saying, right? So you have, yeah, out of the blue, right? Out of the blue, you have no business interest whatsoever, but suddenly on Monday morning, you go to your broker, you call your dealer to buy euro. Why? Because you got some inspiration on Sunday night, and you had maybe you had a prediction the day before that the value of euro, the value of dollar will appreciate, will increase. So you buy it the next day. Okay, so you don't have any business, underlying transactions that necessitate you to go to the foreign exchange market to buy euro or dollar or anything. You see the difference, right? So previously, Taewon actually has a business interest, right? It has US dollar at stake, but Sungwook just goes to the market for speculation.
Actually, the professor talked too fast. Yeah, I'm not good English. Yeah.
Okay, got it. Thank you. Yeah. So again, so you go to the market without any underlying transactions. Right? So you just got prediction, maybe the previous day, right? So it's out of the blue. Maybe you got a prediction, you had a dream, and you go to market to speculate, to gamble, right? So you hope that your prediction is correct. That's the difference between Tae-Woong and Song-Wook, right? Tae-Woong, in the previous example, he had big interest in US dollar, because in December, he will have to pay the Apple Max in US dollar. That's a hedging process. So he tries to protect the value of the transaction that will actually happen in December. Okay, so you got the big difference, right? Speculator is similar to a gambler. You go to the market out of the blue, you try to get money using your pure prediction without any underlying assets or transactions. If you have questions or comments, feel free to unmute yourself and speak up. So this is the traditional system. See, if we want to buy, and maybe the other entity want to sell. So traditionally, we will call our broker, intermediary, like broker or dealer, and the broker will have representatives at the the computer system, at the brokerage, the electronic systems for brokers and dealers, and they will find one another. So we don't need to know. For example, we want to buy US dollar. We call it buy. We call it in the long position. This is the common terminology in the financial market. So if you want to buy something, it means that you are taking a long position. And if you want to sell something, usually we call it a short position. So if you take a long position, you don't need to know who will take the short position. You don't need to know, right? For example, here, Jinsu, right? Jinsu, you want to buy US dollars, so you are taking a long position in US dollar at the spot market. But Moon, you take the short position. You are the person who wants to sell US dollar, meaning that you want to buy won, and on the other hand, Jinsu wants to sell won, right? So Jinsu wants to buy dollar, Moon wants to sell won. Sorry, Moon wants to sell US dollar, but you don't need to know one another, right? So each of you will call your respective brokers, right? And the brokers will execute everything for you. And of course, you have to pay for the transaction cost, right? The transaction fee. And so it's very simple, so you don't need to know. However, you see that the modern system, we have a lot of electronic system, or we call it automated system. So nowadays, the function of broker has been diminishing, right? Has been decreasing. We don't need broker that much anymore. It's very similar to, I think, the industry, the insurance industry. Right, in the past, you could imagine that if we wanted to buy an insurance policy, we would call our agents, right? Insurance agents would take care of the paperwork, right? They would fill out everything for you because we are lazy, right? We are the customers, we are lazy. Okay, please fill out everything for me. So you fill out my name, you fill out my occupation, even the income and everything. But nowadays, because of the automated system, we have a lot of the electronic insurance companies. You could imagine, right, because of the enhancement of technology. So it's same thing here with the broker in the stock market, in the foreign exchange market. Now the function of broker has diminished, right, has decreased because of the technology. So many of us could go simply to our laptop and fill out anything, right? We want to buy certain amount of dollars, a certain amount of euros, or anything. But traditionally, again, we use the brokerage firm, right? They did a lot of things for us, but we didn't need to know, or even today we don't need to know who is the seller, right? Or if we are taking the selling position, we don't need to know who the buyer is. Who cares, right? We don't care who the buyer is, who the seller is. As long as our transaction can be executed. So yeah, there's a funny story about the insurance industry from my experience. You know, when I graduated from high school, some of my friends decided not to go to college, so they stopped at high school and they became insurance agents. So it's a funny story here. And you know, like 20 years later, right, I graduated from high school like 20 years ago. So 20 years later, we see some of my friends who didn't go to college but decided to become like insurance agents have become very rich. Yeah. So they have a BMW, they have Mercedes, they have good houses and something like that. And some of us, you know, who actually went to college, become envious, you know, yeah, a bit jealous, right? To see, you know, some of them are super rich, right? But when we meet in a high school reunion, you know, my friends who have become insurance agents, right? They told us that the fight or their career was really difficult. You know, you can imagine that 20 years ago when they became insurance agents, not many people wanted to buy insurance policies. So they had to, you know, go like door to door, like they knock every door, you know, like relatives, right? Their parents, their some other, you know, family members. They had to knock like every door to sell the insurance policies. So their struggle from that 20 years ago was really really huge, right? Difficult career, difficult selling. But of course today, 20 years later, we see that some of them have good cars, good houses, and we are asking, right? So why should we go to college, right? So this, I mean, it's a bad question to ask, but again, the struggle like 20 years ago for the insurance industry was really really big, right? Really huge in the past. But nowadays, of course, it's quite easy to sell insurance policies because people are more aware. People are more willing to protect themselves, right, through the insurance policies and something like that. So the world has changed, right? So you can imagine the function of broker as well, they have changed. So this is the famous system, one of the famous system in the world, at the clearinghouse interbank payment system, CHIPS. So foreign exchange transactions in the US will go through the CHIPS system or through the FedWire. So now it's of course computerized network in New York. So again, this is the American system, and every country will make its own clearing system. In Korea, you have a clearing system. In Vietnam, in Singapore, and everywhere. So we have our own clearing systems. But of course, these transactions have to be, connected, connected throughout the world. You see another example here, CHAPS in the UK, Sagittaire in France. Yeah, you have different names for every country. This kind of systems throughout the world have to be connected. Right? That's why we have, for example, if you want to send money to many countries in the world, they will ask about the SWIFT code, because this is the interbank connection system. They will ask about SWIFT code. If you want, especially if you want to deal with the American companies, right, you need the SWIFT code to send money or to receive money from. On the other hand, if you deal with European companies, most likely you will need this one, the IBAN number. In Europe, they call it IBAN, but yes, in English, IBAN, right? So IBAN number for European companies and SWIFT code for European type corporations. So we have the connections throughout the world. using the electronic trading system. So again, this is a lucrative market. Maybe some of you are working in this industry, or some of you are thinking about it. Again, the pie is big, right? The money is really big. Even we are a small company, most likely we'll still enjoy a good amount of money, because again, the pie is really big. And another key to the automated trading system, another key to the widespread use of the technology is liquidity. So liquidity has been increasing, of course. Liquidity means what? You can buy and sell quickly and easily. So there's no barrier to the transaction. So if the liquidity is high, it will be more interesting. Of course, some currencies are not that liquid. So major currencies in the world are very liquid, right? For example, if you mention your own currency, Korean won, Japanese yen, what else? Of course, US dollar, euro, Singaporean dollar, Australian dollar, Canadian dollar. They are all very liquid. Right? Liquidity is high. You can buy and sell quickly. Some other currencies are not that liquid, of course. Less famous one. If you mention whatever, maybe Czech, right? The Czech Republic, Czech koruna, right? So or zloty, right? The Polish zloty, Poland, right? Polish zloty, or yeah, some other currencies. Many other currencies are not as liquid as the major currencies, of course. But in general, if we are talking about liquidity, it has improved a lot. Right? So if you do transactions, you can be sure, right? Yeah, you can be sure that the liquidity is quite guaranteed. If you want to sell it again, you can sell it quickly. If you want to buy it again, you can buy it quickly. And size, we talked about this, you see, 5 trillion daily. Even this is in 2016. Now it's more than that, right? More than $5 trillion per day. It's per day, right? I can imagine $5 trillion a day. So it's a really lucrative market. Can you imagine if you work at this industry for 10 years, you will be able to, I think, collect a lot of money, and then you retire, you quit, and you open a store, or you go back to school or anything. Right? That would be, many people are doing that actually. And if you compare this one, yeah, New York Stock Exchange, yeah, it's about 100 billion. It's about $100 billion a day right now. At that time in 2018, it was $77 million, but nowadays it's close to 100 billion. It's already big, right? It's big enough, right? $100 billion a day is big, but compared to 5 trillion, this is crazy. Crazy amount, right? $5 trillion a day. So it's really very tempting career to go, actually, especially when we just graduate. And what's the difference between the equity market and the foreign exchange market? For the foreign exchange market, you see the biggest market is in London, right? The biggest is in London, followed by New York, and then surprisingly now Singapore has surpassed Hong Kong. And I think you can imagine why, because Hong Kong is now not as independent as it was before. Right now it's essentially a special province of China, right? But in the past, before 1997, Hong Kong was the financial capital of Asia, right? Because it had the British financial culture. It's Asian country located in Asia, but it had more Western type of financial markets and everything. So it was very very compelling to investors at the time. But now Singapore has surpassed Hong Kong as the third, because of its location, because of its something in the middle, right? Of course it's Asian. They also eat rice, right? Singaporean also eat rice, like Asian in general. But in terms of the financial markets, in terms of the business culture, is in the middle, not really east, not really Asian, but yeah, in the middle, right, between the west and the east. So that's the, I think, the major interest of Singapore to the investors. But in the equity market, the biggest equity market is in New York. Equity market, the stock market, right? So the biggest stock market is in New York, the New York Stock Exchange. But for the foreign exchange market, the biggest market is in London. And you see the composition is quite high, no, the gap is quite big. London, right? Even New York is almost half of it. Can you imagine? So London is a huge market traditionally for foreign exchange market.
And
so
I have a
daily,
question.
yes,
Actually, I
please.
have a question. Why is the London is the biggest city of the selling or the buying the exchange market?
Very good question, and I have to be honest, I don't really know the history of it. Sometimes the financial industry is following tradition, like following the history. So as long as that one place is not declining significantly, or it's not suddenly disappearing, then the tradition would usually continue. So this is what I mean, right? London had been, or has been one of the major capitals of the world since long time ago, because of the British Empire. So of course at that time we had some other competitors like the Holy Roman Empire, right? Mostly in the Euroland, in Germany especially. We had British Empire until, let's say, before the First World War. So we could imagine that actually the financial industries were centralized in Europe, right? Especially in London and also in certain parts of Germany. But then British Empire became bigger. You can imagine that at one point in time, the British Empire even encompassed half the globe, right? You remember that time, right? The British Empire actually encompassed half the globe because they had Canada. It's big enough, right? Many parts of the America back then, and then Australia, India, even Malaysia, and everywhere. So I think London has been, again, the traditional center for financial markets. But actually, a more interesting question is why New York has become the largest market for equity, for stock market. I think if you follow the development of the banking market, you know that in 1929, suddenly the world was having a big crash. If you watch some movies or you read some books, right, you can find out that in 1929 or 1930, we had a big economic crash all over the world. But you see, every country decided, to do it differently. How to cope with this crisis, right? The global economic crisis in 1929. For example, the UK, the United Kingdom or the British Empire, so they followed what Keynes. So there was an economist named John Maynard Keynes, J.M. Keynes. So Keynes talked about the adjusted capitalism, or they call it neoliberalism, neo-capitalism. So J.M. Keynes said that in a certain situation, for example, during the financial crisis, the government had to go. The government had to go into the market to do intervention. So there was the new version of capitalism or liberalism of J.M. Keynes says that the role of the government will increase if we have a financial crisis. So you see that almost all capitalistic countries in the world today believe in what Keynes said, what J.M. Keynes said. Because now you see, we have a financial crisis, then the government has to go to the market, right, to do intervention, to buy or sell anything, right, or to give money to people and everything. What about the United States now? This is an interesting one. The American decided to blame the banks. Okay, so he said, this happens because of the banking system. So in 1933, suddenly, you know, they made Glass-Steagall Act. So Glass-Steagall Act, these are names, right? Glass and Steagall, two names. You say in American culture, if you have like a certain law, the law will bear somebody's names, right? Usually the senator or the congressman or something like that. So Glass-Steagall Act essentially, you know, broke the banking system into commercial bank, investment bank, and insurance industry. So since 1933, the banking system couldn't become all-in-one service. So if you chose to be a commercial bank, you could not become an investment bank or an insurance company. On the other hand, if you chose to be an investment bank, you could not become a commercial bank, and vice versa, right? And this, you know, this act lasted until 1999. Can you imagine? 66 years. 66 years, right? So the tradition of the banking system had declined. 66 years, right? So everybody now in America, if they needed money, they would go to the capital market. Right? So I have a company, I want to get bigger, I want to take off, I want to expand. Where could I get money from? Of course, in Korea, in Europe, firstly, we would consider the banking system, right? We would go to our bank, we borrow money or something like that. Easy borrowing, right? We go to our bank. But in America, because of this, you see, from 1933 to 1999, the banking system was disintegrated, right, into commercial banks, investment bank, insurance industry. So they would go to the capital market. So the capital market has become a bigger tradition in America. That's why today, you see, the biggest stock market is, of course, the New York Stock Exchange, because in 1999 the regulation was repealed, right? So they call it Financial Services Modernization Act. Modernization, so modern, right? Modernization Act. So Financial Services Modernization Act in 1999. But 66 years later, so you could imagine that the stock market tradition has become very big or very common in the United States. So yeah, so it's a very interesting question. London continues to become, you know, the biggest market for foreign exchange, and I think this is just following, I think, the tradition from long time ago. Of course, I'm not a historian, so I just, you know, I could tell from what I read, but didn't really follow, you know, the history. Yeah, I think so. Not necessarily accurate, but yeah, I think London has been there for so many centuries, I can imagine. Yeah, thank you. Very interesting. And transaction, the biggest one, of course, dollar and euro, dollar per euro. Second one is to Japanese yen. Oh, by the way, there's interesting history as well. Again, coming back to that 29, you know, one of your neighboring countries, right? One of your neighboring countries decided to expand their regions, right? See, how to solve the crisis, right? How to solve the crisis. The British decided to use what Keynes said, right? The neo-capitalism. So they adjusted the capitalism. America decided to blame the banking system. But one country in Asia decided to expand their region to capture other countries. Yeah, I don't mention the name of the country, but I think you could imagine, right? So one country in Asia, after the crisis, decided to enlarge the region by going to other countries to capture other countries. So yeah, that's part of history. So we don't put any blame, but see the history. Very interesting. So every country will do different things to cope with a certain financial crisis. USD per Korean won, 1.5% of the total transaction. This is quite big, right? Imagine 1.5% of a big money is big amount. Okay, now we see the technicalities, some calculations. Again, spot means right now. You make the deal right now. You deliver the transaction right now. You execute right now. The forward market, you make the deal right now, but the delivery may happen like 30 days later, 90 days, 180 days, and so on. So we have, okay, this is the interesting one, American terms and European terms. So it's better to do it this way rather than calling them American terms or European terms. Actually, it's better to call them direct quotation and indirect quotation. So the one that we really love is this one, direct quotation. Direct quotation means that you mention the home currency in front and the foreign currency at the back. So indirect quotation means this is foreign per home. Okay? So I'll try quickly, okay? So if I say won per dollar, maybe Nate. So this is what this is direct quotation for who? For Korea or for America?
For Korea.
For Korea. So this is direct quotation for Korea, right? And of course, this is the indirect quotation for America. Easy, right? Easy to imagine. So if this is home per foreign, this is a direct quotation, and most likely we will use this one most of the time, except in certain countries they have more tendency to use indirect quotation. For example, in the UK, right? In England, they are more inclined to use indirect quotation, but in all other countries, most likely we'll use direct quotation, right? So I'll try again. Let's say I have I'll call Yunmi. Yunmi, can you tell us, this is direct quotation for who? This dollar per euro?
Hello.
Yes. Direct quotation for a dollar, okay, for America. Yes, that's right. So this is indirect quotation for Europe, right? Okay, so very easy, right? So very easy to imagine, okay? So most likely we will use direct quotation most of the time, right? Not always, but most of the time. And can see here some example peso. So 37 and 73 cents per dollar, and Japanese yen 113.56 cents per dollar. Right? And we have the forward, like 1 month forward, 3 month forward, 6 month forward, and so on. So again, the forward market means that we could make the deal right now, you make the agreement right now, but the execution will happen sometime in the future. For example, 1 month, at 3 months time, or 6 months time, and so on. You see the names of the currencies in the world. There are a lot of names, but it's a good thing that we have euro, right? So euro, I think it's adopted by maybe 20 countries, so that's good, right? So we could eliminate it, like 20 names. In the past, we had Deutsche Mark, we had franc, franc, we had lira and everything. But now we have one euro, right, for the European market. That's a good thing. So we don't need to memorize too much. But of course, the European market still have Norwegian krone, kroner, maybe some other currencies in Europe. Danish krona, Czech koruna, yeah, some other names. You have Indian rupiah, Indonesian rupiah, Israeli shekel, shekel, right? So it has become famous again, or shekel, because of the existence of the Israel, right? So we have the name shekel again. Turkish lira, Thai baht, right? Vietnamese dong, Swiss franc, right? SF, Swedish krona, of course Korean won, and there are some other things. So we talk about this direct quotation and indirect quotation. Direct quotation means, again, home per foreign. Indirect quotation means foreign per home. So here, again, can you tell me quickly, what quotation is it? Direct quotation for who?
America.
For America, right? Direct quotation for America.
Yeah.
That's right, yeah. Indirect quotation for Japan, right? On the other hand, this is the opposite here.
Japan.
Mm-hmm. Japan, right? Direct quotation for Japan. Indirect quotation for America. Very easy, yeah? That's right. Yeah. Very easy. Okay, now we have bid and ask spread. So this is now interesting, okay? So as similar to the stock price, we have bid and ask, bid and ask. I hope you still remember what's the meaning of bid and what's the meaning of ask, similar to the stock market. Anyone here? Can you tell us? Maybe Hongki? Any idea? What is, again, what is a bid price? Like in the stock market, similar, you have bid and ask. You have bid and ask. Can you tell us, in a simple term, what is actually a bid price? Hongki or anyone, maybe you want to try? What is a bid price?
Bid price is the highest price that the buyer willing to pay, and the ask price is the price that the seller willing to sell the stock or the security.
That's right. Very good. Thank you, Locke. So yeah, that's very true. But for you who are not familiar with this, I will tell you the easiest way to imagine. Okay, so this is buy, easy, right? And this is sell. This is the easiest way to imagine, right? So buy and sell, buy and sell. So if you are familiar with the market, for example, in my case, I myself, I'm in the market a lot, so I've been quite familiar with this, so I will call it like bid and ask, bid and ask. So actually it's buy and sell, but be careful here, buy and sell from the perspective of the broker, from the perspective of the broker. Right? I'll give you an example, maybe, I don't know, maybe today, can you tell me the Korean won? Is it still 1250? Or it changes a bit? What is the rate today? Any idea? Anyone here? Do you follow the exchange rate between won and dollar? Still the same?
It's around 1200.
Oh, again, around 1200. So let's say I'm writing this. And then the ask is, okay, so this is an example, right? So the average is 1200, right? 1200 wons per dollar, that's the average. But we have bid and ask, like in stock market, right? We have the buy. So just remember, bid and ask is simply buy and sell, buy and sell, buy and sell, right? So buy and sell, look at the anchor currency. That's why I always remind you, right? Look at the anchor currency, the currency at the back. This is very important, right? The currency at the back is called an anchor, right? Anchor currency. So, so can you tell me now, anyone here? This is the buy, right? Buy or bid. This is the sell. Okay, so here say Jong-hoon, is it correct? Your name, Jong-hoon. Jong-hoon, if you want to buy, you are an individual. You are not a bank. Okay, you are not a broker. You are an individual. Jong-hoon wants to buy dollar. Which rate will you get? Which one? Which rate, left or right, will you get if you want to buy dollar? Yeah, what do you think, Jong-hoon? If you want to buy dollar, just simply $1 maybe. If you want to buy dollar, which rate will you get, left or right?
I want to buy left side. Okay.
Okay, if you want to buy dollar, you get this one, right? I will explain why. Now, this is buy and sell from the perspective of the broker. For example, the broker is, who is it here? Yunmi, okay? Yunmi, you're the bank, right? You're the bank or you're the broker. And Jong-hoon is the individual, right? Your customer. So Jong-hoon comes to you, right? He wants to buy dollar. Which one again, left or right? Left or right, if Jong-hoon wants to buy dollar?
Oh yes.
Yunmi was, yes, please. Left or right? Yunmi, what do you think? You're the bank, you're the broker. Which one will you sell to him? Left or right? Which one is that, Yunmi? Which one will you sell to him? Left rate or right one? If you want, he wants to buy dollar from you, from Yunmi. So as a bank, as a broker, which one will you sell to him, Yunmi? Left or right? Anyone here? Okay, so Yunmi will sell at the right one, right? Sell, you see? So this is again buy and sell from the perspective of the bank, right? From the perspective of the broker. Okay, Jong-hoon, if on the other hand, if you want to sell dollar, you have dollar, you want to sell it. Which one is that, left or right? You want to sell dollar, Jong-hoon? Which one is that, left rate or right one?
I want to sell right one.
You want to sell dollar? You want to sell dollar? Yunmi will buy it at the left one. So I know it's a bit confusing, right? So again, bid and ask means is buy and sell from the perspective of the broker. So you see the situation, right? If someone wants to buy dollar, so someone comes like Jong-hoon comes to Yunmi is the bank, right? So Jong-hoon wants to buy dollar. Yunmi will sell it at this one. So you see, Jong-hoon, if you want to get $1, Yunmi will ask for 1,210 wons. Easy to imagine, right? So you want to buy dollar, Yunmi will tell you, okay, give me 1,210 wons. However, maybe another day you go to Yunmi again, you say, I want to sell my dollar. So you say, I want to sell my dollar, here's my dollar, and Yunmi will give you 1,190. You see the difference here, the difference is called the spread. The spread that the broker or the bank enjoys. Similar to the stock market, right? If you buy a stock, they will sell you at one price, but if you buy the stock, they will sell, or if you sell the stock, they will buy at a lower price. So remember again, buy and sell from the perspective of the broker, for the perspective of the broker. So I want to make sure that this could be understood well. I'll give another example, okay? Let's say, yes? Any question? So let me try. Oh, please, some of you don't have the Roman alphabet, so I don't know how to pronounce your name, okay? On the screen. What about Ko? Ko is here, Ko? Okay, can you tell us if you want to buy euro, see at the back. If you want to buy euro, which rate is it? Left or right? You are not a bank, you are an individual. You want to buy euro. Bid or ask?
Buy is left, sell is right.
Right, very good. This one, right? If you want to buy euro, you will get this one. Because you go to the bank, again, for example, Yunmi is the bank. You go to Yunmi, you say, I want to buy euro, and Yunmi will ask for 110, right? They'll ask, oh, so where's your $1.10, right? On the other hand, if you want to sell euro, then of course it's this one, right? So if you want to sell euro, you go to Yunmi, you hand in your euro, Yunmi will give you $1.05. Right? You see the difference is called the spread, right? Bid and ask spread. So Yunmi will sell euro for 110, but Yunmi only wants to buy euro at 105. You see the spread is called again the spread of profit, right? Profit to the bank or profit to the broker. I hope again the easiest way to imagine is bid and ask is buy and sell, but be careful, buy and sell from the perspective of the broker. From the perspective of the broker, okay? So buy and sell from the perspective of the broker. Okay, so what is the spread? And we have the traditional formula here, just like the stock return calculation, right? The ask price, so it's bid and ask, right? Ask price is always higher, bid price is lower. Again, this is buy and sell from the perspective of the bank, from the perspective of the broker. So ask price minus bid price divided by the bid price, right, times 100. It should be bid price. Any question about the bid and ask to make sure? Because we'll use a lot of them from now on. We use a lot of bid and ask. It's quite clear, bid and ask, so buy and sell from the perspective of the bank or broker. Right? So we'll continue with the cost rates. So cost rates, this is very easy to see the definition. Cost across something. So here's the thing. In the past, if you follow the story of the International Monetary System, after 71, essentially we didn't have any fixed rate system anymore. Before 1971, we had the Bretton Woods system. The Bretton Woods system was essentially a pact or a fixed system where major currencies, all other currencies in the world, had to be pegged to US dollar or gold. On the other hand, the US dollar was pegged to gold. Right, so under the Bretton Woods system, essentially every currency was pegged to US dollar and US dollar to gold. So it's like semi-gold system. Right? But after 71, there has been no more, any pegged system or fixed rate system. So almost all countries in the world are using the free floating or certain kind of a free floating system. However, in the past, or since 1971, actually we didn't have, we have not had the direct connection between one currency to another currency. So for example, if I know in the past, okay, if I know the won per dollar rate, and I know in this example, yen per dollar. So in the past, I actually didn't really know the connection between won and yen. So I have to use cross rates, right? Because I only know won per dollar, and I only knew yen per dollar, but I didn't really have the what's that, direct connection between won and yen. But nowadays, of course, we have, right, because of the computer and the technology. So we are talking about the traditional common practice since long time ago, right? Common practice in the world about the cross rates. But nowadays, of course, we have everything. We have won to whatever Singaporean dollar, won to even Chinese yuan. Chinese yuan. The currencies sound similar, right? The renminbi and the yuan, Chinese yuan and Japanese yen, so similar word, similar Chinese character, of course, Chinese kanji. So what to do with it is very easy mathematically. So if I know, for example, here this, and I know, so what is the won per yen or yen per won? This is a mathematical formula, right? Mathematical formula. If I know won per dollar, if I know yen per dollar, how do I eliminate dollar? It's by division, right? By division. When you divide it, it will become like this. Okay, it's mathematical formula. So you get won per yen. Very easy, right? Let me change it a little bit. What if I know and so if I want to know I want to know this. Cholo, could you please tell us what will you do? Will you divide or multiply? Cholo, are you here or anyone?
Multiply.
Okay, let's try. If you multiply, it would be so this is wrong, right? So there's no connection. So that's right. So you will multiply, right? So if you multiply, then you get, okay, very easy, right? You see mathematical logic. So what I mean here is that you don't need to memorize, okay? This is not memorization. This is a mathematical logic. I mean, sometimes we multiply, sometimes you divide. It's simply because of the mathematical convenience, right? So mathematical convenience that can help you. For example, here we know that this is yen per dollar, and the other one is won per dollar. So how to get the cost rate? Of course, we divide. Right? We divide. Right? You could either way, this one divided by this one, or this one divided by this one, doesn't matter, because it will determine only what will be in front, what will be at the back. So if you do it like this, you will get what? divide, right? You divide. So you multiply by dollar per, so you get yen per won. Right? But if you do it the other way, of course you will get won per yen. Right? For example, here is this one, right? So yen per dollar divided by won per dollar. So we get yen per won. We divide, we get yen per won. Right? So if you want to change it back, you just 1 divided by this number, you get won per yen. Right? Just a mathematical configuration. You divide here, you multiply there. Any question about cost rate?
So I have a question.
Yes, please.
Yes, so there is a difference between the cross rate and the real rate. The excluding the transaction cost, there would be the arbitrage. There can be an arbitrage.
That's right. If the cost rates are not accurate, then we have the opportunity to get arbitrage profit. Just imagine that we have a computer system right now, and the cost rates are changing from time to time, and we do the programming, right? Programming on our laptop, we are saying that if the cost rate is wrong by, let's say, 10 points, because remember, the cost rates also have bid and ask, right? So sometimes, even if we have the arbitrage profit or arbitrage opportunity, we don't get any profit because of this, because of the transaction cost. So actually it's profitable, but after deducting the transaction cost, it's not profitable anymore. So we tell our computer, if the cost rates are mistaken by 10 points, then execute it. So you can imagine, everybody here, let's say all of us are traders, are brokers. So we have our own programming, right? We have our own programming, and everybody is doing the same thing. So that makes the arbitrage profit disappear quickly, because everybody will compete. Like, for example, I tell my computer, if I have 10 points, computer, execute the transaction, take a buying position. And you have another programming. You have your programming that says, if the cost rate is minus 7 points, execute the transaction. So every trader has his or her own computer system and programming. So we are competing. Because of the competition, the arbitrage profit will appear quickly. But you're right. There's a possibility that if the cost rate is wrong, then actually we could make an arbitrage profit. We can make an arbitrage profit, but it has to be quick. Maybe it will disappear within 5 seconds or 7 seconds nowadays. But in the past, I think the arbitrage opportunity would last for maybe 1 hour, 2 hours, a good time for traders, right? In the past. That's why you see that all traders were very rich in the past, right? They were all very rich because they had a lot of arbitrage. They gained a lot of arbitrage profit because of the asymmetric information for maybe 1 or 2 hours. Yeah, that's very true. But we'll continue our calculation, and like what you said, we can see whether we have the arbitrage opportunity from the cost rates. Right? So let's do this exercise. So we have here, now we have bid and ask. Brazilian real. So we are calculating the cost rate. Right? Brazilian real is this. Right? Let me write down there. So real per dollar. So Brazilian real per dollar, and we have bahts. and the ask is so if you look at the quotation, see they don't even mention the 25 anymore, because if you're a trader, you're working in this industry, of course you know what they are talking about, right? What we are talking about, right? All 25, no, 25, 13, and then 39.86. So they assume that you understand already, you know, the 25. Right? So this is the common practice there. So what is the cross rate? So now you have bid and ask, right? We have bid and ask. So the question is, what is the cross rate between real and baht? So we know real per dollar, and we know baht per dollar, right? But we have bid and ask. So what is the cross rate between real and baht? So this is quite quite easy actually, but it requires some calculations. So now let's imagine. Maybe I'll start from John again, from John, because you're there. So now let's imagine you have real, okay? You have real in Brazil, right? You have real, and you want to sell your real to get dollar. So you want to buy dollar, right? So the same thing, right? You want to sell real, it means that you want to buy dollar. If you want to sell dollar, it means that you want to buy real. Is it the same thing, right? Same meaning, because we have two currencies. That's why this course, International Finance, is a bit more complicated than the stock market course, portfolio management, because in the stock market, you only have one thing, right? You have a stock, you have bid and ask, of course, but you have one thing. You have a certain stock. But in the foreign exchange market, you have two things here. You have real and dollar. You have baht and dollar, and you have bid and ask. So John, again, can you tell us, if you want to sell real or you want to buy dollar, which one is it, left or right? You want to buy dollar.
Right.
What do you think? If you want to buy dollar, right? Yeah, that's right. Yeah, that's good. So yeah, right. Yes, right one. So you want you're in Brazil, right? You have real. You want to sell your real. You want to buy dollar, and they will give you this one. Imagine, right? You go to the bank. You say, I want to buy dollar, and the bank will sell it to you at 10076. Agree, right? Agree? Anyone here? Everyone? So again, this is buy and sell, but from the perspective of the bank, right? So John goes to a bank, goes to his broker. He wants to buy dollar. The bank will sell it to him at 10076. Right? So if John wants to buy dollar, he will get this one. Okay. So let's continue the story. Okay. I will continue with another person. Maybe I'm seeing Jong-hoon. Yeah, Jong-hoon. So now you have dollar, right? Remember? Let's say you are the same person as John before. So John sells real, right? So he just got dollar. He got dollar. Now he has dollar. Now Jong-hoon, you continue the story. Now you have dollar. You go to Thailand, right? You want to sell your dollar to get bahts. So you want to sell dollar. Which one is it? Left or right? You want to sell dollar to get baht. So you want to sell dollar, right? Left or right? What do you think? Jong-hoon or anyone? If you want to sell dollar, left or right?
Right.
I want to sell right one.
If you want to sell dollar, you will do it at the left one. Remember, this is buy and sell from the perspective of the bank. Okay, from the perspective of the bank. So imagine again, right? Jong-hoon, now we have dollar, you have $1 or you have $1 million or any amount. Okay, you have dollar. You want to sell the dollar to get baht, right? So you go to the bank. You say, I have $1 here, and the bank will buy it from you at this one. Right? So you want to sell dollar. It means that this is the rate the bank wants to buy from you. And remember which one is buy? Buy is this one, right? The bank wants to buy dollar from you at left one, 25.13. So I will summarize, okay? So when John went to the bank, went to his broker, he said, I wanted to sell real to get dollar. So essentially he wanted to buy dollar, right? So he went to his bank and he wanted to buy dollar. The bank would give him this one, right? Because he wanted to buy dollar, right? So the bank would sell it to him at 0076. Now Jong-hoon, right, you have dollar, you have $1, you have $1 million or anything. So you want to get bahts, right? Thai bahts. So you go to your bank, you say, I want to sell my dollars. I want to sell my dollars. So they will give you the left one, because you want to sell dollars, meaning that the bank wants to buy from you, right? And buy is this one, right? Yeah, I know at first it's quite confusing between the buy and sell, right? Because the buy and sell is from the perspective of the broker, from the perspective of the broker. But along the way, when you finish this course, you'll be an expert in this kind of things, you know, calculation, in numbers, in imagination, and especially, you know, you are Korean, right? And by ethnic, you are Korean, and usually the East Asian people are very good at mathematics. So don't worry about it. I'm sure you imagine this very quickly. You see, like Korean, Vietnamese, Chinese, Japanese, we are very good at mathematics. You know that, right? So after you finish this course, you'll be able to imagine this very easily, right? So now continue the story. Once again, okay. John went to his bank. He wanted to sell real. He wanted to buy dollar. The bank will give him this one. So he wanted to buy dollar. Right? So the bank would give him this rate. But Jong-hoon, now you have dollar. You want to sell your dollar. The bank will sell you at this. The bank will buy from you at this one. So you want to sell dollar. The bank will buy from you at this rate. So now we see the cross rate is between divided by and why we divide again? Because the dollars are both at the back. I see the logic here. If I divide it by what's that? Real. This would equal. So you can cross it, right? Okay, that's why we divide. So it's not memorization, okay? It's not like something, it must be a division. No, not necessarily true. We divide because we need to divide. Okay, this is not a memorization, so it's case by case, okay? But in this case, we divide because we will get the baht per real. So how much is it? Let's calculate together. This is it correct? If you calculate also. So this is one rate. I will keep this one. Okay. Yeah, I hope you get the same results. Okay. You can check also on the textbook. It's yeah, this one, right? Okay, so let's continue the story. Now I'm it's called Nate, okay. Nate, so now a different situation, okay? The reverse situation. Now you have bahts, okay? You have bahts, and you want to sell your bahts to get dollars. Which one is it? Left or right? This one or this one? You have bahts. You want to sell bahts. You want to get dollars.
I would like
Left or right?
Left one.
You want to buy dollar? Left or right?
I would like to buy left one.
You want to buy dollar, you will get the right one. Why is that so? Because you go to your bank, remember, right? You go to your bank, you say, I want to buy dollar. So the bank will sell it to you at this one, right? Okay, so yeah, I know it first, so it's a bit an aspect. It's quite, yeah, buy and sell. But think about it again, right? Nate, you go to your bank, you say, I have bahts. I want to sell my bahts. I want to get dollars, right? So you say, I want to buy dollars. So the bank will sell it to you at this one. Okay, so again, you want to buy dollar, you will get it at you have to pay 25.3986 bahts. So let's continue. Let's say who is it here? Yumi, maybe Yumi. Yumi, if now you have dollar, right? We continue from Nate. So Nate went to his bank. He sold his bahts, so he got dollars. Now you have the dollars at Yumi. So Yumi, you have the dollars. Now you want to sell the dollars to get real. Which one is it, left or right? You want to sell your dollars.
Yeah, maybe right too.
Say it again.
Hello, is it
Yes, you want to sell your dollars. Left one, yeah, very good. Right, see, you go to your bank, right? Yumi goes to her bank, and she says that she wants to sell her dollars.
left
so the
one?
bank, left one, right? The bank will buy at left one. Yes, Yumi? Yeah, left one.
Professor,
Okay,
I
left
cannot
one.
hear
So-
you.
Hello, can you hear me? Yes. Yes. Can you hear me? No sound? The others, can you hear me?
Yeah, we can hear you.
Oh, okay. Test. Yeah. Yumi, can you hear me now? Oh, Yumi cannot hear me. I don't know, but all others can hear me.
Yes, I can
Test.
hear you.
Okay. Yumi, maybe your speaker needs, what's that? Fine tuning or adjustment. Maybe you turn it off and turn it on again. Yeah, not sure what
Yeah,
happened.
now I
but-
can hear you.
Oh, okay, good, yeah. So the left one, right? The left one. So you want to sell your dollar, right? You want to sell your dollars. The bank is willing to buy from you at this one. So once again, right, buy and sell, right? So from the perspective of the bank. So so let's calculate now the right one. So is divided by, again, I divide not by memorization, okay? This is not like something that, oh, you have to divide, no, but remember again, baht per real, you have the, what's that again, real per, yeah, baht per dollar, real per real. So if you divide, you get baht per real, right? So you divide just because of the mathematical necessity. So what's the number? So this would equal, let's calculate together. Okay, now we get the two rates, right? Get the two rates. So this is the bid, right? And this is the ask. You see here, 250608. So we'll write it this way. Okay, so we understand already that the number is 25, right? So 5134. Okay, so this is the cost rates if we have bid and ask. So we did do the cost at the costing, but I want to make sure that this is clear enough. So let me try again from after Nate Taewong. Okay, so maybe if I have here I have one per dollar. Okay, $1 per dollar. I make number maybe, oh, maybe I create a number. So let's say and I have another currency. What is? I don't know. Yeah, just use yen, okay? Yen. Yeah. Yeah, just to want to make sure. Taewong, Taewong, if you have dollar, okay, you have dollar. You want to sell your dollar to get won. So you want to sell your dollar, left or right?
I want to sell.
You want to sell your dollar.
Right side.
Say it again.
Right side. Right.
Actually, if you want to sell your dollar, you get the left side.
Yeah.
Right. You want to sell your dollar, right? So the bank will be willing to buy from you at this one.
Yeah.
Left one, right? Huni, tell us, you have dollar, okay? You want to get yens. So you want to sell your dollar to get yens. Left or right? You want to sell your dollar to get yens. Left or right?
Left side.
Left side, very good. Right. So you can imagine it faster. Jong-hoon. So now you have yens, okay? Jong-hoon, you have yens. So you want to sell your yens to get dollar. You want to sell your yens to get dollar. So you want to buy dollar. Left or right? You want to buy dollar. You want to buy dollar? Left or right?
Left one.
Should be the right one, okay? Because again, this is buy and sell from the perspective of the broker. So if you want to buy dollar, they will give you the right one. You want to buy dollar, right? Because it's buy and sell from the perspective of the bank, right? It's okay, yeah. So we continue again. So Songwoo. So now tell us again, if you have wons, okay, you have wons, you want to sell the wons, right? You want to sell wons to get dollar. So you want to buy dollar, left or right?
Right side.
Right side, very good, right? So now you become more familiar with this one, right? So I know it's always confusing because it's buy and sell from the perspective of the broker, right? So from the perspective of the individual, it's like sell and buy, sell and buy, sell and buy. But from the perspective of the broker, we say it's buy and sell, right? Buy and sell from the perspective of the broker. Okay, so I hope now you become more familiar. Okay, so arbitrage transaction, we see again, we will get arbitrage opportunity if the cross rates are wrong. Cross rates are wrong, meaning that it's not equal. For example, we have, again, from the previous example, we have won and dollar, we have yen and dollar. So if the won per yen exchange rate is wrong, it maybe it's too high or too low, then you have the opportunity to get the arbitrage profit. Unfortunately, again, in the computer, in the programming era like this, every trader has sophisticated applications, sophisticated computer programming. So this kind of opportunity will disappear within maybe 5 seconds. But still, right, 5 seconds are money, right? If your computer programming is good enough, 5 seconds can turn out to be big money because you can execute quickly. If you tell your computers, your big data analytics and your artificial intelligence, you tell them, okay, if the cross rates are mistaken by 10 points, execute it immediately. And of course, the opportunity will disappear within 5 seconds, but still 5 seconds could mean money. So most likely, this will become like no arbitrage condition, right? No arbitrage condition. So let's see an example here. This is a simple example of no arbitrage situation. So where's the information here? So you start with 1 million, for example, $1 million. The spot rate is this one. This is the spot rate right now. You have 1 million. Okay, so you want to get euro. So you divide or you multiply? Can you tell me quickly? You divide or you multiply? They're the same in front. Moon, can you tell us quickly? You see, you have $1 million. This is the spot rate. You divide or you multiply?
Multiply.
You multiply, right? You multiply, you get this one. 670,016 euros. Okay, now you have this one, right? So then you want to exchange here. The rate is 129.98 per euro. And your money is this one, see? 670,000 euros. Who is next? You divide or you multiply? Oh, what is it? You divide or you multiply? Say it again.
Divide.
They're the same at the back, you see? Oh, no, they're the same in front. That's true. Yeah, that's correct. You divide, right? They're the same in front, so it's quite confusing. Yeah, this one is, see, the symbol is wrong. So it's euro per pound. So yeah, that's right. You divide 670,000 divided by 129, so you get this one, right? You get this one. So 515,476 pounds. And the cross rate here is this one. Okay, of course, you know by now, see, this is pound, this is dollar per pound, so they're the same at the back. right? They're the same at the back. So you multiply, right? You multiply. So you multiply, you get 1,001,159. So this is wrong, right? Something is wrong here because you start from 1 million, you end up with 1,001,000. So every $1 million that you trade, you get free money of 1,159. This is called an arbitrage, arbitrage profit. So certainly the cross rates are wrong, and this example is intentionally showing something wrong, right? So you see that if the cross rates are wrong, you can get this kind of profit. But remember, this is a simple example. This simple example doesn't have bid and ask. When you have bid and ask, things become more complicated because remember, you have to buy at this rate, but you have to sell at another rate. So this kind of things might disappear quickly or become smaller, become like not really interesting to execute, right? So that's why you tell your computer, you will execute this kind of discrepancy, this kind of mistake only if the arbitrage profit is big enough to justify the transaction cost, the technological cost and everything. But this is an example that the cross rates are wrong. It's possible, right? But in the modern times like this, where we have like enormous information, we have good programming system, this kind of miscalculation and misconception will appear only for maybe 5 seconds or 7 seconds, and it will disappear because of the again, the technology, right? The equilibrium will come back. So what do you think here? Maybe the what is wrong here is between the three, right? Some rates are too low, some rates are too high, but you see, right, because of technology and this information comes to place, and one trader will tell one another, see, oh, I noticed that there's a mistaken cross rate between dollar and euro, or between euro and pound, and let's execute on it. So every trader will have the opportunity to do it quickly, and finally this will disappear because the information will be quickly incorporated into the new price. Okay, so settlement date, this is quite self-explanatory. So settlement, again, for the spot transaction, the settlement will happen maybe today or tomorrow or 2 days from now, but most likely between T+2 or T+3, right? And for the forward market, this could be, could be next week, could be 30 days later, could be 60 days, 180 days and something. We have some, of course, we have exchange risk, right? So because of the new, the volatility of exchange rates due to new development, right? Political news, economic news, recession, election, presidential election, some changes in central bank governors and whatever, right? So here spot I think is quite clear. We have, this is about international trade. Maybe you have taken some other courses about international trade, or maybe you are doing it in your business. You export and import, and you can imagine that both exporters and importers need the correspondent bank. So if you're an importer, you are exporter, very easy to imagine. Let's say Huni, you are an importer. Maybe you import fish, okay? And the exporter is who is it here? Yunmi, okay? Yunmi, you are the exporter. So it's very simple to see that if you don't have any bank, if you do the transaction directly, right? Directly between Hunmi and Yunmi, what's the problem here? Hunmi as an importer, or maybe Yunmi first as an exporter. What are you afraid of? Yunmi, maybe you send fish. You send fish from Vietnam. You send fish to Hunmi. What are you afraid of? You send the fish, but the money never comes, right? So Hunmi never pays, right? And on the other hand, Hunmi, you have a similar fear, right? You have similar fear What is your fear, Hunmi? You pay her, right? You pay her, but the fish never comes. The fish never comes. So both of you are afraid of one another, right? So this way you need your corresponding bank. So the importer, right? You tell your bank. Hunmi, you tell your bank to write an LC, right? Letter of credit, or maybe in foreign currency, right? Maybe in Vietnamese dong or something, right? So your corresponding bank will communicate with the corresponding bank or the bank of the exporter. They will communicate, right? They'll communicate, and this bank is telling, no, this bank, so I'm ready to pay. So we have a promise or acceptance. We call it banker's acceptance. So the bank is promised to pay. So this bank will inform the exporter, right? Yunmi's bank will tell Yunmi, okay, the other bank has accepted, has agreed to pay if something happens to the importer. Also, because the exporter, Yunmi, hears from the bank, okay, it's okay. Now Yunmi will send the fish. Will send the fish. And once the ship arrives at the seaport, right, the bank will ask for the money, right? This is a bank, will ask money from Hunmi. Okay, pay me now. So if the importer already pays the bank, then the bank will allow the importer to get the fish. Right? Simple, right? So this is a relationship that needs both banks because nobody trusts one another, okay? So you don't want to send the fish and the money never comes. Or you don't want to send the money and the fish never comes. So you have to use the both banks. So you have nostro account, right? You have a contract note and everything related to the international transaction, international trade. Okay, so I think this is quite clear. We have settlement risk. Right? Settlement risk means one bank pays the transaction, but the other bank hasn't paid. So this is quite ridiculous, right? I think in modern times this can never happen again. But in the past, you know that the technology was not that good. Right? Technology was limited. So there was a possibility in the past that, for example, you have a transaction valued at 100 million. This is a big money, right? Big money, and you are a bank, right? So you have a transaction $100 million against maybe whatever, maybe 1.2 trillion or something, right? So you submit the money to the central bank, 100 million, but you never receive this one on that day because it's closing. So you might be in trouble, right? Because suddenly you hand in $100 million, but you don't get the yens that day. You have to wait until maybe next day. And this is Saturday, remember, right? If you did it on Friday, you submitted $100 million, but you didn't get the yens, you had to wait until Monday. That's scary, right? Scary for a bank because suddenly you don't have money. Your liquidity position is going down because of that kind of transaction. So you paid 100 million, you never got the yens until Monday. So we call it Herstatt risk. Herstatt is a name of a bank in the past. So this happened in the past. Nowadays, I don't think this could happen because we have a lot of things like the PVP system and so on. Okay, one more thing for this chapter, forward market, right? A little bit more, but it's very similar. So forward contract, again, you make the deal right now, but the delivery, the execution will happen sometime in the future. Could be next week, could be next month, and so on. And we have short and long. Remember what I told you before? Long means buying position, right? And short means selling position. So to make it easy to imagine, okay? So in the financial markets, we always use the long and short. So long means buy, short means sell, right? Long something. So long means you hold something, right? You buy or hold something. Short means you let it go, right? So you are selling something. So forward contract is not an option. We'll see option 2 weeks from now. Forward contract. So you make an agreement right now. you make an agreement right now, but the delivery will happen sometime in the future, and you have to execute the forward contract, right? The forward contract. So let's imagine the situation now. See. Okay, so let's continue the previous example. So in December, who was it again? Daewon. Daewon, you make a deal right now with Apple Corporation, right? Apple Corporation in December, you will get let's say, what's it again? 1,000 laptops, right? 1,000 new version of MacBook, right? And each will be priced at 2,000. So you know that in December you will have to pay 2 million.
Yeah, 2 million.
Yeah, 2 million. Okay. And today, the exchange rate is 1,200 per dollar. Right? This is today, right? Today. So, what are you afraid of, Daewon, in December? What are you afraid of in terms of won per dollar? You have to pay $2 million in December. Now
Yeah.
it's 1,200 won per dollar.
I afraid increase the value of dollar.
That's right. That's very good. So again, you are afraid of appreciating dollar, right? Increasing value of dollar, because who knows, in December, dollar has become like 1,300, right? Or 1,350 or 1,400 won per dollar. So you don't like this one, right? You don't like this one. But anyway, in December, you pay $2 million, right? So the $2 million don't change. $2 million don't change, but won per dollar will change. So now what can you do? First alternative, doing nothing. You don't care, right? You don't care. So if you don't care, you are gambling, okay? Because you hope that, in December, who knows, this will become cheaper, right? Right? So you are happy if this is cheaper, right? Because you will pay $2 million. You always pay $2 million, but if this is cheaper, or you are happy, that's why you say, oh, I don't care. I don't want to do anything. I hope that dollar will be cheaper. Dollar will depreciate, right? But this is dangerous, right? This is dangerous because you are gambling. Right? So if you do nothing, it's the same as gambling. Right? Essentially, if you do nothing, you are gambling, because who knows, this will be on the contrary of your expectation. This might become 1,300 or anything. You will be in trouble. Right? So how to hedge yourself? So you're doing hedging now. You try to hedge against this foreign exchange risk by doing what? So now you go to the forward market. December, how many months from now? 3 months. So 90-day contract. You make a 90-day contract because it's 3 months from now, right? 3 months from now. So the contract, actually we'll talk about this a lot next week, right? In details about the forward or futures contract. But suffice it for now to imagine that the forward contract, in this case, is quite flexible. So you take a notional value of 2 million. You make a contract, right? 2 million for 3 months, and the rate is like this. So you take it, right? So now this is very easy, okay? So which one will you take, long and short one? It depends on what you need, right? Let me ask a quick question. Ryu, can you tell us, if you are afraid that so Ryu, if you're afraid that a certain thing will increase in price, you buy it first or you sell it first? You see one computer here. You're afraid that the computer will increase in price. You buy it first or you sell it first? You buy it first. Very good, right? Very good. And on the other hand, if you expect If you expect something to decrease in price, then you buy it first or you sell it first?
Sell.
You sell it first, right? Very, very good logic. So this is what I want to tell you, okay? When you go to the derivative market, you go to forward or futures market, actually you don't need to analyze anything, okay? You make your decision based on your interest. You see the example here. In December, you are afraid of increasing dollar. Okay, like what Tae Wong said, right? So you are afraid of increasing dollar value. So you buy it first or you sell it first?
Buy first.
You buy first. Very easy, right? Very easy. So you don't need to think, right? This is not like something you need to memorize or you need to analyze or anything. It's simple logic, right? So you're afraid of appreciating dollar, right? Increasing dollar value. Then you buy it first now. That's why you go to the forward contract, you take the long dollar position. So this is not memorization, okay? You don't need to memorize, oh, I have to long dollar, I have to short dollar. Nothing like that. It depends on what you need. So in this example, Tae Wong needs to long dollar, right? Like what you said, right? You need to long dollar. Why? Because in December, you're afraid that the dollar will appreciate. You're afraid the dollar will increase in price. That's why you long dollar. So let me use another example. Here, Jinsu, okay? Jinsu, just do it quickly. If you're afraid that, let's say I have this, right? I have this rate. So I'm afraid that euro will depreciate. Right? Euro will decrease in price. So what position should I take in the forward market? Or anyone? You want to tell me? You're afraid that euro will depreciate. What position should you take in the forward market?
Short euro.
Say it again.
Short euro.
Short euro. Very good. Easy, right? See? So it depends on what's happening, okay? So if you're afraid that oil price will increase, then you take a long position, right? Long position in oil futures. If you're afraid that oil price will decrease, then you take a short position in oil futures. Very simple, right? Very simple. So that's why now we go back to our story here. We have to long dollar because in December, we are afraid that dollar will appreciate. So what happened now? The price is 1,250. So you take a contract. How many contracts is that? Let me calculate quickly. So you need 2 million, right? 2 million, and one contract is 1,250. So 1,600 contracts, and long dollar. So you long dollar 1,600 contracts because 1,600 multiplied by this is 2 million, right? Because your exposure is $2 million. So again, you take a long position at 1,600 contracts, long position in US dollar. Okay, so what happened on a certain day in December? In December, let's say the real spot rate, right? The spot rate in December has become, wow, this is bad, right? 1,300 won per dollar, right, in December. So you have to pay Apple how much? 2 million. How much won is that? You multiply. You multiply. So you have to pay, what's that? 2.6 billion. Right? You have to pay Apple 2.6 billion wons, right? Or $2 million, right? $2 million in December. However, remember, like now in September, back then in September, you already had a forward contract. Then your forward contract said that you would buy long dollar, right? Long dollar at 1,250. So you had the contract to buy dollar in September, but the delivery will happen in December. 2 million. So how much is it? So you buy dollar at 250. So 2.5 billion only, right? 2.5 billion. So you understand what I'm saying, right? In December, you will get, you buy dollar, 2 million, right? You buy $2 million by handing in, by submitting 2.5 billion wons, right? So you pay 2.5 billion wons, you get $2 million. And then you use the $2 million to pay off Apple, right? So you get some benefit there, right? Rather than paying 2.6 billion wons in December, actually you only need to pay 2.5 billion wons. Right? So this is again the logic of forward and futures that we are going to see a lot next week, right? So it's very useful tools for everyone, right? The derivative contract. Okay, so you gain money from the forward contract, and then you use the money to pay off the main transaction, right? The main transaction with the Apple Corporation. Okay, so we have some terminologies there: outright rate, and we have the swap rate. This is how to read, for example, here. See how to read the forward contract. This is 20015 to, if you want to write the outright rate, outright means that all rate, so you can write it this way, 0015 per pound to 0030 per pound. This is called outright rate. This is called swap rate, right? Just a name. And here you see the 30-day forward, 19 minus 17, right? And on the other hand, the Swiss franc, the CHF Swiss franc, is increasing 4 to 6. So if the number is decreasing, it means this is like forward discount. And we talked about forward discount last week, right? So discount means decreasing value of the one at the back, decreasing value of pound. Right, so what would be the forward rate here? Here, 96, because it's minus 19, right? Minus 19, and 13 here, 13 because it's minus 17. Okay, and on the other hand, the Swiss franc here, Swiss franc, 69.63 to 68. So this is plus 4 and plus 6. Plus 4, yeah, plus 4, then plus 6. Okay, it's very easy. So again, if you see increasing numbers like this, 4 to 6, 9 to 14, it means that this is a forward premium. Forward premium, right? The plus 4, plus 6. But if you see a descending number, this is minus discount. So minus 26, minus 22, minus 42, minus 35, right? That's the way to read it. And one more example, right? Before we see your presentation quickly. So if we combine the story here, yeah, we don't need to calculate, just see the example here. So this is in UK, this is in yen. Okay, and this is the spot rate, spot rates. These are the spot rates, and these are the forward rates. Okay, so remember the interest rate parity that we talked about last week. A country with a higher interest rate will most likely see its currency depreciate. So you see, we combine here. This is a interest rate parity. A country with a higher interest rate will most likely see its currency depreciate. Okay, so let's see. Can you test whether there are arbitrage? This is similar to what John was raising, right? Again, the issue that John was raising some minutes ago. about the arbitrage opportunity. There's a possibility. Then we can check, right? We can check, for example, you can try from yen. Okay, so we have two interest rate here, 7 per 16%, and 7, 5 per 16%. So who is it here? Alokha, can you tell us quickly, if you want to borrow money, you are individual, you are not a bank, okay? If you go to a bank, you want to borrow money, which interest rate will they charge you? This one or this one? You want to borrow money?
The right one.
If you want to borrow money, they will charge you the left one. If you want to invest, they will give you the right one. If you want to invest, they will give you the right one. If you want to borrow money, Lokha, you're correct. They will charge you the left one, right? So you borrow money, they charge you 16%. And on the other hand, in Japan, can you tell us quickly, Cholo, are you there? Cholo, can you tell us quickly, if you want to borrow money in Japan, they will charge you the left one or the right one? Or Nate, maybe? If you want to borrow money in Japan, you have two interest rates here. Which one will they charge you, left or right? Anyone, maybe? You want to borrow money?
I don't know about the right one.
If you want to borrow money, they will charge you the higher one because bank wants to make profit, right? They lend you money at a higher interest rate, but you want to save money, they will give you a lower one. Right? Common sense, right? If you're a bank, you can imagine if somebody wants to borrow money from you, you will charge the higher interest rate. But if somebody wants to save money, you give the guy a lower interest rate. That's how they make money, right? So again, you borrow money at this one. They will charge you the higher one. You borrow yen, okay? You get the money, you convert the yen into pounds at the spot rate here. Which one is it, left or right? So you have yen. So you have yen, you want to get pound. So yen per pound. So you have yen, you want to buy pound, left or right? Anyone? You want to buy pound, left or right? This one or this one? You want to buy pound, you have yens, right? Because you borrow money in yen, you want to change it to pound. So you want to buy pounds. Left or right again? Anyone? You want to buy pound? Jinsu, maybe? Left or right? Buy pound. This is yen.
Right?
Right, yeah, that's right. So you want to right one. Yes, the right one. So you want to buy pound, they will give you the right one, right? So you change it, right, at this rate. See? Okay, now you have pound. You have pound. And then you invest in UK. So you invest in UK, left or right? Which interest rate will they give you? If you invest, you save money, left or right? If you want to borrow, they will charge you the left one. But if you want to save,
right one.
This one, right? Right one, the lower one. So you can get certain amount of money. Then because you know that you have certain amount of pounds in 3 months time, then you make a forward contract right now. You make a forward contract right now. So you have pounds in the future, you have pounds in the future, and you want to sell it in the future, but you make the deal right now. It's called forward contract, right? So you want to take a short pound position right now, but the execution will happen 3 months later. Left or right? You want to sell pound. You want to short pound. You make the deal right now, but the execution will happen 90 days from now. Left or right? Short
Left.
pound, sell
Left.
pound, left. Very good. Yeah, very good. So this rate, right? So you get certain money, and you can check whether you can get an arbitrage profit or not from this kind of transaction. Right? So now we reverse it. Now you borrow pounds, right? You borrow pounds. I will do it quickly because it's just the reverse. You borrow pound at this rate. The second alternative here. You borrow money in pounds. You exchange it with yen. Which one is it? Buy yen, long position in yen. Or your long position in yen means short position in pound. So you sell pound. Left or right, you sell pound.
Left.
Left, yeah, you sell pound and left. Or you buy, essentially you buy yen, right? Buying yen is similar to selling pound. So you change it with this one, change it to yen. Okay. And then you invest yens. So you invest the yen here, left or right. You want to save money in yen. Of course, the lower one, right? The lower one. So you get this rate, and you know that in 3 months, you have a certain amount of yen, a certain amount of yen. Because you know that in 3 months time, we will have certain amount of yen. You make a contract right now. You make a contract to sell yen, but you make the contract right now to short yen, but the execution will happen 3 months later. We call it forward contract, right? So left or right, short yen. Short yen means long pound. So you want to buy pound, left or right? You want to buy pound, left or right?
Left.
Anyone, quickly? You want to buy pound? You want to short yen, meaning that you want to long pound. Buying pound is left or right? It's the right one, right? Right one, remember? You want to buy pound, right? So you want to short yen or you want to long pound. You make the deal right now, but it will happen 3 months later. And yeah, we have time running out, but yeah, we don't do the calculation by ourselves. But you see here, according to the text, the second alternative will give you an arbitrage profit. Alternative 2 will give you arbitrage profit. Oh, so if tonight or maybe tomorrow, if you cannot sleep, please try to calculate this, okay? So if you cannot sleep, it will help you sleep faster. You can verify the numbers, but according to the textbook, the second alternative will give you an arbitrage profit. Like what John was raising, like the issue John was raising, there's a possibility to get arbitrage profit, but again, because of technology and the modern information spreading, this kind of arbitrage profit will quickly disappear because of the information being incorporated into prices, right? So this might happen for 5 seconds or 7 seconds. But see the logic, okay? I hope you understand the logic. Yeah, so the left and right. So I think we can stop here because next week we'll see a lot of forward and futures calculation.